Morgan, you had excellent second quarter results. They beat expectations significantly, both on the revenue and on the earnings line. But it's more about the outlook for the balance of this year and into 2022. And so the bottom line is margins have been the story. The operating leverage in U.S. corporations is significant across so many different sectors. Margins are now back right now at 12% net margins. Those are the highest in the record highs, more than 100 basis points more than they were pre-pandemic. So that's excellent. And we look out into 2022, margins are likely to stay very robust. The big risk, if you will, from an earnings point of view is the tax reform and just how much that may diminish the growth rate. So bottom line is rates are likely to be staying low. Earnings are still pretty robust, albeit with the risk of more modest growth because of the tax reform. And that leads us to S&P 500 target of around 4,700. And so, Morgan, that's around 7% return from now through the end of the year, and then modest growth into 2022. So that's the forecast.
Yeah, I mean, it's pretty incredible after what we saw in the first quarter and all the fears around inflation and what that did in the Treasury market to see that interest rates, at least for now, are poised to be lower for longer, even as more Fed officials come out and talk taper right now. I wonder how you factor that in, why you think there's been such a shift in the Treasury market, and how that carries over into 2022.
So our baseline forecast is that the 10-year U.S. Treasury yield will climb to around 1.6% by the end of this year. So we are assuming that rates increase modestly. And as a result, the valuation of equities still remains reasonably attractive. There's a whole money story, a money flow story, a component of this, Morgan, to think about. But the alternative for investors is cash that's basically yielding zero. And is unlikely, the Fed, in our view, is unlikely to raise short-term rates until the second half of 2023. So that's 2 more years of basically no return on cash. Bond yields rising slightly. That does not present a particularly attractive environment for fixed income. And so equities become the asset class of choice. And there are 2 real sources of demand for shares right now. The first is coming from corporates. Corporate buybacks have been at record levels now at this point in the year compared with the past. And households sitting on more than $1 trillion more money in cash, money market mutual funds today than before the pandemic. That's like $5.5 trillion versus, say, $4.5 trillion. So those 2 sources of demand are what's helping to drive equity prices over time higher. And that's sort of the outlook now into next year. And so that's the money flow side of it. And the valuation, even if rates go higher, equity prices are still relatively attractive in that interest rate environment. You would have to have rates, 10-year Treasury yields, move towards 2%, 2% to be a headwind, in my opinion, from a valuation perspective for stocks. Not our forecast. Our forecast rises, or 10-year Treasuries rise to around 1.6%. And if you had rates go the other direction, where some clients have a view because of the Delta variant and things may slow down, again, that would suggest equity prices could move a lot higher to sort of 49.50 if you think about it at the index level.